Welcome to the video. Today we will demystify the Backdoor Roth IRA and explain why having a zero pre-tax traditional IRA balance is essential before converting. We will cover the IRS Pro-Rata Rule, show you how to handle old IRA balances, and walk through practical steps to avoid taxes you do not intend to pay. Along the way, we will include examples, diagrams, and short quizzes to help you retain the key points. Let's begin. Here is the plan. First, we will define the Backdoor Roth IRA. Next, we will examine the IRS Pro-Rata Rule in plain language. Then, we will emphasize why a zero pre-tax balance in traditional IRAs is crucial. After that, we will compare two cleanup options: reverse rollover to a 401k and converting the entire amount. We will follow with numerical examples and timelines, call out common pitfalls, and finish with a couple of quick quizzes and a succinct wrap-up. At a high level, the Backdoor Roth IRA involves making a non-deductible contribution to a traditional IRA and converting that amount to a Roth IRA right away. In theory, that should create a near tax-free conversion. However, if you have any pre-tax money in any traditional, SEP, or SIMPLE IRA as of December 31st, the IRS aggregates those balances and applies the Pro-Rata Rule. That can make a portion of your conversion taxable. Therefore, clearing pre-tax funds before converting is critical. The Backdoor Roth IRA is a method for high-income earners to get money into a Roth IRA despite exceeding direct contribution limits. The two steps are straightforward. Make a non-deductible traditional IRA contribution and then convert it to Roth. The objective is to place funds where they can grow tax-free and be withdrawn tax-free in retirement if qualifications are met. The crucial requirement is ensuring a zero pre-tax traditional IRA balance on December 31st of the conversion year to prevent the Pro-Rata Rule from creating an unexpected tax bill. The Pro-Rata Rule requires the IRS to look at all of your traditional, SEP, and SIMPLE IRA balances as of December 31st of the conversion year. When you perform a conversion, the IRS considers the ratio of pre-tax money to the total IRA balance to determine the taxable portion. The formula is taxable amount equals pre-tax IRA balance divided by total IRA balance multiplied by the conversion amount. This is why ensuring a zero pre-tax balance is essential. If there is any pre-tax money, a part of your conversion will be taxed. There are two main approaches to eliminate pre-tax IRA balances. First, the reverse rollover. If your employer plan allows it, roll the pre-tax portion from your IRA into the 401k or 403b. This isolates pre-tax funds in the plan and leaves your IRA with zero pre-tax dollars, making the backdoor conversion clean. Second, convert the entire IRA if the balance is small and largely after-tax basis. In that case, you will owe tax only on the gains, provided you previously filed Form 8606 to document your non-deductible basis. If you did not file Form 8606, the IRS will presume the full amount is pre-tax and tax the entire conversion. Let us examine three scenarios. In Scenario A, you have a clean slate, $6,500 all after-tax basis, and zero pre-tax. Converting the full amount results in zero tax. In Scenario B, your total IRA is $20,000, of which $14,000 is pre-tax and $6,000 is after-tax. If you convert $6,000, the taxable portion is $14,000 divided by $20,000, or 70%, resulting in $4,200 of taxable income. In Scenario C, the IRA contains $6,000 of basis and $300 of gains. Converting all $6,300 results in $300 of taxable income. Here is the step-by-step sequence for the reverse rollover. First, verify your employer plan accepts incoming rollovers of pre-tax IRA funds. Second, request a trustee-to-trustee rollover from your IRA custodian, ensuring only pre-tax dollars and earnings move to the employer plan. Third, confirm that your traditional IRA now shows a zero pre-tax balance. Fourth, make your non-deductible contribution to the IRA. Fifth, convert that amount to your Roth IRA promptly. Finally, file IRS Form 8606 to record the non-deductible contribution and preserve your basis. This sequence diagram will illustrate the order of operations. The investor initiates a direct rollover request with the IRA custodian. The traditional IRA then sends only pre-tax funds to the employer 401k. After the transfer, the investor confirms that the traditional IRA shows a zero pre-tax balance. With the path cleared, the investor contributes a non-deductible amount to the traditional IRA and converts it immediately to the Roth IRA. Executing these steps in this order helps avoid the Pro-Rata Rule. When the IRA balance is small, converting the entire amount can be efficient. First, locate prior. Form 8606 to verify your non-deductible basis. Next, check the current value to determine the gains. If basis is properly documented, only gains will be taxable. Then convert the full traditional IRA balance to Roth. Ideally, set aside cash to pay the taxes instead of withholding from the conversion. If needed, file or amend Form 8606 to correctly reflect your basis. Finally, keep all statements as proof of contributions, basis, and conversion timing. Common mistakes include retaining any pre-tax IRA balance on December 31st of the conversion year, failing to file Form 8606 to document non-deductible basis, and cashing out small IRA balances, which can cause both taxation and the early withdrawal penalty if under age 59.5. Additional missteps include withholding taxes from the conversion, which reduces the amount entering the Roth, waiting too long between contribution and conversion, and thereby creating taxable gains, and forgetting that SEP and SIMPLE IRAs are included in the IRS aggregation for the Pro-Rata Rule. This timeline clarifies the recommended pacing. Early in the year, verify that your employer plan accepts roll-ins. Next, roll pre-tax IRA dollars into the 401k. Then, make your non-deductible traditional IRA contribution and convert to Roth within the same week to minimize gains. By the October 15th extended filing deadline, ensure Form 8606 is filed or amended as needed. Finally, by December 31st, confirm your pre-tax IRA balance is zero to avoid the Pro-Rata Rule. Quiz time. The question is, why is a zero pre-tax traditional IRA balance by December 31st essential for a clean backdoor Roth conversions? Option A, it maximizes contribution limits. Option B, it avoids the IRS Pro-Rata Rule from making part of the conversion taxable. Option C, it increases Roth IRA investment choices. Option D, it defers taxes until retirement. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The zero pre-tax balance ensures the Pro-Rata Rule does not cause part of your conversion to become taxable. Second quiz. The question is, what does IRS Form 8606 do in the context of backdoor Roth IRAs? Option A, it authorizes a 401k rollover. Option B, it documents non-deductible IRA basis so only gains are taxed on conversion. Option C, it replaces your tax return. Option D, it eliminates early withdrawal penalties. And you may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Form 8606 documents your non-deductible basis. Without it, the IRS assumes the amount is pre-tax and may tax the entire conversion. Let us validate the math. The taxable portion equals the pre-tax IRA amount divided by the total IRA balance multiplied by the conversion amount. For example, with $14,000 pre-tax and a total of $20,000, converting $6,000 results in a taxable amount of $4,200. If you keep pre-tax IRA balances at zero, the fraction becomes zero, and the conversion is tax-free. Here are the key takeaways. First, maintain a zero pre-tax traditional IRA balance by December 31st of the conversion years. Second, use either a reverse rollover to an employer plan or convert the entire amount if the balance is small and mostly basis. Third, always file Form 8606 to record your non-deductible basis. Fourth, do not cash out small IRA balances because that can trigger taxes and penalties. Finally, time each step carefully and maintain thorough documentation. Disclaimer: this video is for educational purposes only and is not tax, legal, or investment advice. Tax laws and plan rules change, and individual circumstances differ. Consult a qualified tax professional who can evaluate your specific situation. The examples shown are simplified and may not cover all cases, including state tax implications. To recap, the backdoor Roth involves contributing non-deductible funds to a traditional IRA and converting them to a Roth IRA shortly afterward. The pro-rata rule will apply if any pre-tax IRA balance exists as of December 31st, potentially making a portion of your conversion taxable. Keep pre-tax IRA balances at zero, either by rolling them into an eligible employer plan or converting the entire amount when it is small and supported by a documented basis. Finally, ensure Form 8606 is correctly filed to preserve your basis and minimize taxes. Thank you for watching. If this helped you avoid a tax surprise, please like the video, share it with someone who needs it, and subscribe for more practical guidance. Post your questions or scenarios in the comments. We may feature them in a future video.